Chapter 12 discusses performance evaluation. It's obviously very important for companies to evaluate how well the company is performing as a whole, how well divisions are performing, how well managers within the companies are performing. So in this chapter, we're going to look at some different ways to evaluate all of those different segments and all of those different people. Obviously, the goal of performance evaluation is to provide information useful for assessing the effectiveness of past decisions so that future decisions can be improved. Now, in order to help us make decisions and how decisions are made, a lot of that depends on how the company is organized. And so we have what we call responsibility accounting. It's an accounting system that provides information relating to the responsibilities of individual managers. And the reason we want to do this is because you only want to evaluate managers on items that they are able to control. Obviously, you are evaluated based on how well you perform on your exams. You don't want your grade in the course to be subject to how those around you are doing. And so the same is going to hold true once you have a job. You only want to be held accountable for items that you actually have control over. So in terms of what you have control over, companies can be structured differently. We can have, with the decision-making process, we can have what we call centralized decision-making or decentralized decision-making. With centralized decision-making, that just means that decisions are made at the very top level and lower managers are charged with implementing the decisions. Meaning if you're a lower level manager, you actually do not have any say-so necessarily in the decisions that are made. You're simply there to take orders and implement whatever you've been told to do. And that works okay in a very, very small company. If it's, an individually owned company, they have one location, obviously a lot of the decisions or all the decisions will be made with top level management. But if you have a very, very large company, if you have a company with offices and divisions throughout the world, it's not going to make sense for one person to sit in an office and make decisions for everybody. So most of your larger companies are going to have what we call decentralization. What happens in decentralization is that decision making is going to be pushed down to the lower levels. So it allows managers at the lower levels to make and implement key decisions pertaining to their areas of responsibility. And the decision making is delegated to those lower levels of management. This is just a chart that kind of shows you how this is going to work. You have top management, they're going to push decisions down to middle, even down to the supervisor level, local level. Those people are also going to be able to make some decisions. Reasons for decentralization: ease of gathering and using local information. Obviously, the quality of decisions is affected by the quality of information available. So if you have a really, really large company, as the company grows in size, people at the local level are going to be the best people to make decisions locally. For example, you have McDonald's, and McDonald's has restaurants around the world. Well, what's going to work for a location here in Texas may not work for a location in China or in France. So, people in the U.S. need to make decisions for the stores in the U.S., even broken down regionally. Maybe what works in the South isn't what works in the North. So we're going to have managers that are in the South make decisions for the stores that are located in the South. Because, a person here in Texas may not know what's going on in China. So that wouldn't be the best person to make a decision. So it's just easier to gather and use local information by someone who is actually physically located in that same place. Focuses the central management. By decentralizing the operating decision, central management is free to engage in strategic planning and decision making. So instead of the top management sitting thinking, well, what should we offer in our Lubbock, Texas location, they can sit back and think about the long-term goals. Strategically, where does the company need to go? How do we need to grow? Things along those lines. The third is training and motivating of segment managers. If you're charged with the decision making, if you're allowed to, make your own decisions, if you're given some responsibility, then you're going to take a sense of pride in that. You're going to take a sense of pride in making the best decisions and implementing that decision and doing the best job possible. So it's going to motivate those managers. If you're in a centralized process where all you're doing is giving your marching orders, then you don't have a lot of sense of pride. You may or may not really care if the decision gets implemented properly or not. So by having those segment managers charged with having their own decisions to make, then it's going to give them a sense of pride. It's also going to train those managers so that they can move up the chain, so to speak. So you could have a local manager to become a regional manager up to a top manager. Enhanced competition. In a highly centralized company, overall profit margins can mask inefficiencies within the various subdivisions. So if that just means that if you are just looking at net income for the company as a whole, yeah, overall the company might be doing well, but different divisions or different segments within that company, different regions within the company may not be operating as well or as profitably as possible. So if you have a decentralized company, then each division, each department, each region, you're going to calculate income for each of those. And so if the income isn't as high as we think it should be, or if that division has a loss, then it's going to be a lot easier to pinpoint, where those issues are and hopefully be able to make some changes so that that division can become profitable, then the overall company can become more profitable. Responsibilities centers, it's just the third way divisions differ is by the type of responsibility given to the division manager. As a firm grows, top management typically creates areas of responsibility, and we call that responsibility centers. So a responsibility center is just a segment of the business whose manager is accountable for specified sets of activities. So we're just going to go through that. The first is what we call a cost center. In a cost center, a manager is only responsible for the cost. So somebody that could be in a cost center could be like a production supervisor. Obviously, if you're in production, then all you're doing is incurring costs in order to get that product produced. So that supervisor would only be held accountable for the costs that he can control. That would be a cost center. A revenue center would generate revenue. So a manager is responsible only for sales or for the revenue. So we're not going to worry about expenses. So that could be a salesperson. So a salesperson, they're only concerned about going out and seeing how much they can sell. They're not concerned about the expenses or any cost. A profit center would be a manager who is responsible for both the revenues and for the expenses. So that would be a profit center. Obviously, if it's a profit center, you're going to evaluate them based on how profitable they are. The fourth is an investment center. In an investment center, a manager is responsible for the revenues, costs, and for the investment. So basically what it means for an investment is if the company is to go out and invest in property, plant, and equipment, like purchase a long-term asset, that manager we need to be able to evaluate that manager to see, did he or she make a good decision or not? Like, was that a good purchase? Was that a good investment? So we're going to look at some different ways to evaluate an investment center. One way to measure the performance of an investment center is to use what we call return on investment. So return on investment is just a percentage, and basically what it is it's the profit earned per dollar of investment. So your formula to calculate ROI is to take your operating income and divide it by the average operating assets. So operating income is going to be your earnings before any interest expense and before any income taxes are paid. So operating income is going to be our earnings, our income before any interest and before any taxes. Your operating assets are all the assets acquired to generate operating income. So it is going to include cash, receivables, inventories, land, buildings, and equipment. To calculate average operating assets, what you're going to do is you're going to take the assets at the beginning of the year. To come up with average operating assets, for your formula for average operating assets, you want to take your assets at the beginning of the year, add them to your ending assets, and divide by 2. So again, your formula for average operating assets is to take beginning assets plus ending assets and divide by 2. That's going to give you your average operating assets. We do break ROI down into 2 smaller pieces known as margin and turnover. So a margin is the ratio of operating income to sales. So basically what it tells us is how many cents of operating income result from each dollar of sales. So a margin is going to be given in terms of a percentage. The second piece is called a turnover. To calculate turnover, you're simply going to take your sales and divide it by those average operating assets. The turnover tells us how many dollars of sales result from every dollar invested in those assets. So all we're doing is taking our simple ROI formula and we're breaking it down into 2 pieces. So we've got income and we're just adding a sales component to that. So income over sales gives you the margin portion, sales over assets gives you the turnover portion. If you have a question that asks you simply to calculate ROI and you have income and you have assets, you can use the simplified version of the formula. Here's an example for ROI. It says that the company's Western division earned operating income last year as shown. So we have sales minus cost of goods sold, gives you a gross margin, minus selling and admin expense, leaves us with operating income of $48,000. Our operating assets at the beginning of the year were $277. Operating assets at the end of the year were $323. And we want to calculate the ROI, the margin, and the turnover. So again, from ROI, your formula is to take income over average operating assets. To calculate the average operating assets, the formula is to take your beginning assets plus your ending assets and divide by 2. So our average operating assets is $300,000. This is what we want to use for all of our equations. So for simple ROI, operating income is $48,000. Average operating assets is $300,000. So our return on investment is 16%. So our return on our investment is 16%. For margin, your formula is operating income divided by sales. Income is $48,000. Sales is $480,000. So that gives you a margin of 10%. Basically what the margin is telling you is that for every $1 of sales, we have 10 cents of income. Okay, so for every $1 of sales, we have 10 cents of income. For turnover, it's sales divided by those average operating assets. Sales is $480. Average operating assets is $300. Your turnover is just a number. It's not a percentage. So here our turnover is 1.6. And this just means we were able to convert the average operating assets into sales over 1.5 times. So basically 1.6 times. We were able to turn the value of the assets over into the form of sales dollars. So that is your ROI, your margin, and your turnover.